Mortgage closing costs explained. That is the biggest question I have, the consistent question I have with every client that I talk to. And I'm going to break it down to you so it's real simple. If you look at a closing disclosure or a loan estimate, you're going to see a lot of numbers, and you're going to see seller fees, you're going to see buyer fees, and it's really confusing. The mandated forms that we have to use are not very customer friendly. So let me break it down for you kind of as simply as possible. There are three main categories of loan costs. And the first category are your standard hard costs that really aren't going to vary from lender to lender. Part of it will, and I'll tell you. Title and escrow, you're going to pay a title company or an attorney and an escrow company to handle the transaction. That is going to be a portion of the main cost. You're going to probably pay for an appraisal. That's going to be part of it as well. And then you're going to pay taxes on the things that you've used with the attorney, the title company, and then you're probably going to pay some lender fees. Processing and underwriting are standard lender fees with most lenders throughout the country. And this section of loan cost, the hard costs associated with the loan, is usually from $3,500 to $4,500, somewhere in that ballpark. And that varies a little bit from lender to lender, but that's the general ballpark. Category number 2 of your loan costs are things that are out of control of you, of the buyer, and out of control of us, the lender. These are your prepaid items. So when you move into a house, you're going to have to pay for your homeowner's insurance. And what happens there is 12 months of your homeowner's insurance is paid in advance, one time. You're going to have to prepay for property taxes as well. Property tax money is going to get put into an escrow account, so it can be paid out when it's due. In a lot of states, April and October are the due dates for property taxes. And then there's going to be interim interest. And these are your prepaid items. The interim interest is interest that's paid to the bank depending on when you close your loan. So if you close on the 15th of a 30-day month, the house is yours on the 15th, they're going to want their interest from the 15th to the 30th. So you're actually going to pay that at closing, and that will vary a little bit. So that is your second bucket of costs. So the first is the hard costs, title, escrow, appraisal, county recording fees, bank fees, and which totals from $3,500 to $4,500. The second bucket of cost are your prepaid items, and that just is going to vary widely based on the piece of property that you buy, your property taxes, the homeowner's insurance, and all that. And then the third fee, which is completely optional. You can pay this if you want. You don't have to. That is points that you can pay the lender in exchange for them giving you a lower rate. If the best rate today with zero cost is 6%, and you tell your lender that you want 5%, they can probably give you 5%. And in exchange for giving you a lower rate, they're going to ask for more money up front. So your job and your lender's job then is to look at the cost to get the lower rate, see what the savings are with that lower rate, how much is the payment difference between 6% and 5%, and how long is it going to take you to recover those costs. And then you can make a decision as to whether or not it's a good idea to pay points. That was a quick summary of loan costs. I hope that's helpful. If you have more information, more questions about it, of course, I'd love to help you. Reach out to me. Steve Conwent here, your mortgage guy.